Hey guys, it's Eddie here from Delian Property. Today I'm doing a quick video. This video is about why most property investors get stuck at between 1 and 4 investment properties in their portfolio. For 99% of investors, most of them only reach 1 or 2 properties, maybe 3 or 4 at the best case scenario. And I've grown my portfolio to 14 plus properties by the time I was 26 years old, and at the moment I'm still growing that portfolio, but I really just wanted to outline some key factors on how I grew my portfolio so quickly, starting from nothing, and outline some key factors on what mainly holds people back from growing their own property portfolio and not actually getting to where they want to be financially through property. And I'm going to jump right into it. One of the biggest things that holds people back when growing a sustainable and profitable property portfolio is not focusing on rental yields. Rental yields is one of the most important facets of property investing. And if you just clicked into this video, you're not sure what a rental yield is, I've explained it a few times on the Delian Property Facebook page and also our YouTube channel, so you can check that out. So I won't explain it again, but rental yields, basically, why they're important. What I've learned with growing my own portfolio is that the rental yield is basically the difference between the rent coming in and all the expenses going out, and the difference between the purchase price compared to how much rent's coming in. So basically your return on investment. And a lot of investors I see on a day-to-day basis, they just buy property because they think it has a good rental yield. A lot of people don't even actually know what a rental yield is. And if that's the case, then you should stop right now before you buy anything. You should really educate yourself about property investing and have clear set goals on what you want to actually get out of it. But rental yields are very important. I learned what a rental yield was when I was about 16, 17 years old, before I could even buy an investment property. And I figured out that the interest rates at the time were around 6 or 7%. They're a little bit lower now, but I realized that if the interest rates are at 6 or 7%, I would need to buy an investment property with a rental yield of, say, above 7% to be able to service the debt and the other expenses. So, lucky for myself and do a lot of hard work and dedication and commitment, I found an investment property that had a 7% yield, and that covered basically the mortgage repayments and majority of the other expenses. And that property's like tripled in value over the last 7 or 8 years, which has been really, really good. But basically rental yields are very, very important. And I've done a few other videos, but that's what mainly holds people back. They don't focus on rental yields. They focus on 3% yields, 4% yields, 5% yields. A big tip, I would aim for properties that have a, say, 6% yield, 7% yield, 8% rental yield, always within metro areas, bear in mind, but balancing your portfolio. I've purchased properties that have, say, a 5% yield before. So if it's $400,000, it rents out for $400 a week. That's okay, but it's not great. I've then balanced it with a really strong cash flow, a rental yield property that has maybe an 8% yield. So the rent from this one offsets some of the losses from this one. So it kind of balances itself out. So that's a little bit about rental yields. The second one that holds people back from building, getting past 1, 2, 3, 4 properties and continue growing that portfolio is not diversifying. So it's non-diversification. And what I mean by that is I've spoken to thousands of investors over the years, and quite often they get stuck on emotion and they only want to invest where they live. And while it's perfectly fine to invest where you live, one of the biggest things that I've done with growing my own portfolio is not limit myself to just where I live. Because I grew up in Western Sydney, the far outskirts of Western Sydney, and the first property I bought was about 2 hours away from where I lived. And it wasn't due to anything else other than affordability, growth potential, rental yield, and all the rest of it. I had no emotional attachment, so you've got to try to take the emotions out of it. But basically, from that point on, and I've bought properties throughout lots of capital cities. I've only really basically stuck to capital cities within Australia, but I bought in different states. So I might have had, 2 or 3 properties in New South Wales within the capital city, not too far, within an hour or an hour and a bit from Sydney. Then I've bought properties within 30 minutes, 40 minutes of Gold Coast and Brisbane. Then I bought properties within 20 minutes, 30 minutes of Adelaide CBD. Then I plan to buy in Melbourne and Sydney again when the time becomes right. But I've stuck within metro areas and I've diversified to different locations within Australia. I haven't just stuck with Sydney because I live in Sydney, because that would really be limiting yourself. It's putting all your eggs in one basket, and you don't want to have all your eggs in one basket. So diversification is very important. And I guess moving forward to the last one is, I've mentioned it before, getting stuck on emotions. Most people do not get past 1 to 4 properties in their portfolio because they get stuck on emotions. And what I mean by that is they get stuck with how nice the property looks, where the property is, what type of property it is, and they get emotionally attached to the property because that's what most investors do. That's one of the crucial mistakes. And what I've learned with growing my own portfolio is that you've got to try to take the emotions out of the property when you buy a property. And that doesn't mean just buy a property without looking at it, without doing the right research, without doing the right, checks like pest and building inspections and all the rest of it. I'm not saying that. I'm saying that you've got to try to not get hung up on, if it looks beautiful or if it's in this suburb or that suburb or whatever the case is. You've got to try to focus on the rent coming in. Does it have a really amazing rental yield? Is it going to be able to take care of itself? Can it grow in value over time? Is it in a metro area? If it's in a metro area, it's got a good chance that it's going to go up over the next 5, 10, 15, 20 years. Fair enough. And one of the biggest things, is it below market value? I love purchasing properties and I only would buy properties that are below market value or below comparable sales, however you want to call it. So those are some key factors that I guess hold people back. And going through them again, number one's rental yield. You've got to focus on rental yields, learn about rental yields. You've got to also diversify in different locations. Don't just be a sucker and only buy in one location that you live in or a state you live in because you're scared to, that's kind of drawing on emotion and not allowing your emotions to hold you back, where you should be thinking logically with your brain rather than emotion. So, and the third thing is, emotions, of course, not letting emotions hold you. Don't not buy property just because it doesn't have the nicest carpet or you wouldn't personally like to live in it yourself. It's not about where you'd like to live. It's about, creating wealth, building a portfolio and reaching your financial goals. Being in a position that you don't have to go to work and, be annoyed and pissed off and go to work every day, and being able to have properties that can pay you a wage, pay you an income. So that's what I've done. And yeah, I just hope this video has been a little bit of help, outline some of the key factors that hold people back. Don't get held back when growing your property portfolio. And if you would like more information, you can give us a call or send us an email and I'll do my best to get back to everybody. So thanks for watching, guys, and I'll catch you next video. Bye.